ExamPrep.School. Arizona Property and Casualty, Commercial and Non-Commercial Insurance Producer Exam. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Business Owner's Policy, Commercial Auto Policy, Commercial General Liability, Commercial Property Policies, Dwelling Policy Concepts, Federal Laws and Regulations, General Insurance Concepts, Homeowners Policy Concepts, Insurance Regulation, Other Types of P&C Insurance, Personal Auto Policy, Property and Casualty Insurance Basics, Workers' Compensation Laws. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. After passing the Property and Casualty Licensing Examination, within what time frame must an Arizona resident applicant submit the license application to the Department of Insurance? A. Within 30 days. B. Within 60 days. C. Within 90 days. D. Within 120 days. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is C. This option is correct because Arizona regulations require resident applicants to file their license application within 90 days of passing the examination to ensure timely processing and verification. Reason A is not correct. This option is incorrect because the time frame is too short. Applicants have more time to submit the application. Reason B is not correct. This option is incorrect because the department allows a longer window than 60 days for submission. Reason D is not correct. This option is incorrect because the maximum period allowed by regulation is less than 120 days. Question 2. Which document must a non-resident property and casualty producer applicant provide to the Arizona Department of Insurance when applying for a license by reciprocity? A. Certificate of Completion of Arizona Pre-Licensing Education. B. Letter of appointment from a resident agent. C. Certification of licensure from the home state DOI. D. Fingerprint clearance card issued by Arizona DPS. The correct answer is C. This option is correct because non-resident applicants must furnish a certification of licensure from their home state DOI to establish eligibility under Arizona's reciprocity rules. Reason A is not correct. This option is incorrect because pre-licensing education is not required by Arizona for non-resident applicants under reciprocity. Reason B is not correct. This option is incorrect because reciprocity applications do not require an appointment letter from a resident agent. Reason D is not correct. This option is incorrect because fingerprint clearance by Arizona DPS is not required for non-resident reciprocity applicants. Question 3. When applying for a property and casualty business entity producer license in Arizona, the entity is required to designate which of the following? A. A managing general underwriter. B. A resident office manager. C. A licensed individual producer. D. A compliance officer approved by the department. The correct answer is C. This option is correct because Arizona law requires each business entity to designate at least one licensed individual producer to accept responsibility for the entity's insurance activities. Reason A is not correct. This option is incorrect because appointing a managing general underwriter is not a statutory requirement for business entities in Arizona. Reason B is not correct. This option is incorrect because there is no mandate to designate a resident office manager for licensing purposes. Reason D is not correct. This option is incorrect because business entities are not required to appoint a DOI-approved compliance officer. Question 4. According to Arizona revised statutes governing insurance advertising, which of the following constitutes misrepresentation? A. Failing to disclose premium rates alongside an advertised policy benefit. B. Stating that a policy covers damage from flood perils when floods are explicitly excluded. C. Presenting a policy's coverage limits as lower than the actual amounts to appear more affordable. D. Omitting any reference to the insurer's financial stability rating in an advertisement. The correct answer is B. The correct answer describes a false statement about policy coverage of an excluded peril, meeting the statutory definition of misrepresentation in insurance advertising as any untrue or misleading statement of material fact. Reason A is not correct. Withholding premium rate information is an omission rather than a false statement, and misrepresentation requires untrue or misleading statements. Reason C is not correct. Understating coverage limits does not involve a false statement of fact, but rather understates benefits. Reason D is not correct. Leaving out a financial stability rating is an omission and does not constitute a misleading or false representation as defined by statute. Question 5. An Arizona property and casualty agent offers a $50 gift card for every $500 of annual premium, written to attract commercial clients, promotes authorized group discounts for certain occupations, and provides complimentary policy brochures and free risk management seminars. Which practice constitutes an unlawful inducement, rebating, under Arizona law? A. Providing a $50 gift card for every $500 of annual premium written. B. Promoting authorized group premium discounts for certain occupational groups. C. Distributing complimentary brochures that explain policy coverages. D. Conducting free risk management seminars for policyholders. The correct answer is A. Providing a monetary gift tied directly to premium volume is an unlawful rebate under Arizona law, whereas authorized group discounts, informational brochures, and risk management seminars are permissible promotional activities. Reason B is not correct. Authorized group discounts are specifically permitted under Arizona market conduct rules. Reason C is not correct. Distributing printed policy information is a permissible marketing tool, not a rebate. Reason D is not correct. Offering educational seminars does not constitute an inducement tied to premium volume. Question 6. What is the primary purpose of the Fair Credit Reporting Act as it applies to insurance underwriting? A. To require insurers to base insurance premiums strictly on credit scores of applicants to achieve standardized risk-based pricing practices. B. To prohibit insurers from using consumers' credit histories as part of underwriting decisions in order to prevent discriminatory premium determinations. C. To require consumer reporting agencies to maintain accurate and relevant credit information and furnish it to insurers for evaluating applicants' insurance risk. D. To grant insurers unrestricted access to consumers' full financial and credit history to enhance loss prediction models without oversight. The correct answer is C. The Fair Credit Reporting Act establishes obligations on consumer reporting agencies to ensure the accuracy, relevance, and proper use of credit information when furnishing reports to insurers for underwriting purposes. Reason A is not correct. This misstates the Act. It does not mandate strict premium setting based solely on credit scores. Reason B is not correct. The Act does not prohibit credit histories in underwriting, but governs accuracy and permissible use. Reason D is not correct. The Act restricts, rather than grants, unfettered access to consumer financial data. Question 7. Under the Fair Credit Reporting Act, what must an insurer do when it takes an adverse underwriting action based in whole or part on a consumer report? A. Provide the consumer within a reasonable time after adverse action with notice identifying the credit reporting agency, its contact details, and the right to obtain and dispute the report. B. Send the consumer a detailed explanation of underwriting criteria and risk assessment factors used, including credit score weightings within 30 days after adverse action. C. Notify the consumer only if the adverse action is based exclusively on credit score, omitting disclosure when other risk factors predominate. D. Offer the consumer a complimentary copy of their credit report and a summary of rights on an annual basis, regardless of whether adverse action was taken. The correct answer is A. The FCRA requires that any adverse action based on a consumer report triggers a notice to the consumer within a reasonable period that identifies the reporting agency, provides its contact information, and explains the right to obtain and dispute the report. Reason B is not correct. The Act does not require insurers to detail underwriting criteria within a fixed 30-day period. C. Require the insured to destroy the damaged equipment on site. Reason D is not correct. Annual credit report offers are not a substitute for the required notice following adverse underwriting decisions. Question 8. A property inspector working for an insurer that underwrites policies across state lines intentionally omits material facts about prior structural damage when completing an application for coverage under a federal flood insurance program. Which action violates 18 U.S.C. 1033? A. Failing to timely pay a claim in accordance with policy terms without notifying the insured. B. Omitting material facts from an insurance application submitted in interstate commerce. C. Utilizing an unapproved claim adjustment methodology contrary to company guidelines. D. Marketing misleading premium rates without federally mandated disclosures. The correct answer is B. Under 18 U.S.C. 1033, knowingly omitting material facts in an insurance application transacted in interstate commerce constitutes a prohibited act of insurance fraud. Reason A is not correct. Failing to pay a claim timely without notice is regulated under state unfair claim practices, not the federal insurance fraud statute. Reason C is not correct. Using an unapproved adjustment methodology breaches internal guidelines, but does not fall under 18 U.S.C. 1033's prohibited acts. Reason D is not correct. Advertising misleading rates without disclosures violates state marketing regulations, not the federal fraud statute. Question 9. Which of the following statements best distinguishes pure risk from speculative risk? A. Pure risk involves deliberate actions to achieve profit, whereas speculative risk arises from random events. B. Pure risk involves only the possibility of loss or no loss, whereas speculative risk involves potential for loss or gain. C. Speculative risk is limited to financial transactions, while pure risk applies exclusively to physical property. D. Speculative risk can be eliminated through loss prevention, while pure risk cannot be controlled. The correct answer is B. The correct answer is that pure risk entails only the chance of loss or no loss, while speculative risk includes the possibility of both gain and loss. Reason A is not correct. This reverses the nature of the risks. Profit-seeking actions define speculative risk rather than pure risk. Reason C is not correct. Risk categories are not confined to specific types of assets. Speculative risk can apply beyond financial transactions. Reason D is not correct. Both risk types can be influenced by prevention measures. Control is not a defining difference. Question 10. Which of the following is not one of the 5 principal methods of handling risk in insurance? A. Risk avoidance. B. Risk retention. C. Risk transfer. D. Risk separation. The correct answer is D. The correct answer is that risk separation is not listed among the 5 core methods, which are avoidance, retention, reduction, transfer, and sharing. Reason A is not correct. Avoidance is one of the 5 principal methods used to handle risk by eliminating exposure. Reason B is not correct. Retention is a core method in which the insured bears part or all of a loss. Reason C is not correct. Transfer is one of the primary methods often achieved through purchasing insurance. Question 11. Which of the following best describes a key characteristic of an ideally insurable risk? A. Exposure units must be widely heterogeneous to diversify risk. B. Losses must be fortuitous and beyond the insured's control. C. Loss probability must be so high that underwriting is unnecessary. D. Catastrophic losses affecting many insured simultaneously are preferred. The correct answer is B. The correct answer is that an ideally insurable risk features losses that are random and unexpected from the insured's standpoint, ensuring unpredictability. Reason A is not correct. Homogeneous exposure units are preferred to allow for accurate pooling and prediction of losses. Reason C is not correct. High certainty of loss undermines insurability by making loss frequency predictable and premiums impractical. Reason D is not correct. Catastrophic losses create correlated large-scale exposure that insurers seek to avoid. Question 12. A business owner deliberately exaggerates water damage in a minor flood claim to receive a larger payout, and also fails to regularly inspect the premises, assuming insurance will cover any resulting loss. Which classification correctly identifies the exaggerated claim activity and the omission of routine inspections? A. Exaggerating the claim is a morale hazard. Omitting inspections is a moral hazard. B. Exaggerating the claim is a moral hazard. Omitting inspections is a morale hazard. C. Both exaggerating the claim and omitting inspections are moral hazards. D. Both exaggerating the claim and omitting inspections are morale hazards. The correct answer is B. The correct answer is moral hazard for the intentional exaggeration of losses and morale hazard for the careless omission of routine inspections, aligning with standard definitions. Reason A is not correct. This response reverses the definitions. Deliberate exaggeration constitutes moral hazard, not morale hazard. Reason C is not correct. Moral hazard requires intentional misconduct, whereas careless neglect represents morale hazard. Reason D is not correct. Morale hazard involves negligence or carelessness, so intentional exaggeration cannot be classified as morale hazard. Question 13. In a non-participating stock insurer, which entity is entitled to receive declared dividends from residual corporate earnings? A. Policyholders of the insurer. B. State guarantee associations. C. Holders of participating policies. D. Stock shareholders of the insurer. The correct answer is D. This option is correct because stockholders hold equity in non-participating insurers and receive dividends from corporate profits when declared. Reason A is not correct. Policyholders of non-participating insurers do not have ownership rights to corporate profits. Reason B is not correct. State guarantee associations protect policyholders in insolvency. They do not receive insurer profits. Reason C is not correct. Holders of participating policies are associated with mutual insurers, not stock insurers. Question 14. In a mutual insurer issuing participating policies, which group holds the residual equity interest and may receive dividends from surplus earnings? A. Policyholders of non-participating policies. B. Stockholders holding shares in the company. C. Participating policyholders as owners. D. State regulatory authorities overseeing insurers. The correct answer is C. This option is correct because mutual insurer policyholders are owners of the company and share in surplus through dividends. Reason A is not correct. Non-participating policyholders do not participate in surplus distributions of mutual insurers. Reason B is not correct. Mutual insurers have no stockholders, so they cannot receive dividends. Reason D is not correct. State regulatory authorities oversee insurer operations but do not receive insurer surplus. Question 15. Which classification applies to an insurer formed outside the United States but licensed to conduct business domestically? A. Insurer organized under state laws where it transacts business. B. Insurer incorporated in one U.S. state but operating in another. C. Insurer permitted to write policies for non-admitted risks. D. Insurer formed outside the United States but licensed domestically. The correct answer is D. This option is correct because an alien insurer is one domiciled outside the country but authorized to transact insurance within it. Reason A is not correct. An insurer organized under state laws where it transacts business is a domestic insurer. Reason B is not correct. An insurer incorporated in one U.S. state but operating in another is a foreign insurer. Reason C is not correct. An insurer writing non-admitted risks refers to surplus lines, not an alien classification. Question 16. A surplus lines producer is approached by an insured whose specialized industrial risk was declined by admitted insurers. Under Arizona law, before placing coverage with a non-admitted insurer, what must the producer verify? A. That at least two authorized admitted insurers have declined the risk, and the non-admitted insurer appears on Arizona's eligible unauthorized insurer list. B. That one admitted insurer has declined the risk, and the non-admitted insurer holds at least a B financial strength rating. C. That every authorized admitted insurer in Arizona was offered the risk and all declined. D. That the non-admitted insurer holds a certificate of authority issued by the Arizona Department of Insurance. The correct answer is A. The correct answer is that Arizona law requires a diligent effort to place coverage with admitted insurers, typically two declinations, and the non-admitted insurer must be on the state's approved list of eligible unauthorized insurers before placement. Reason B is not correct. Requiring only one declination and a B rating is insufficient. The law specifies multiple declinations and listing requirements, rather than a rating threshold. Reason C is not correct. Mandating declination by every admitted insurer is overly burdensome and not required. Law requires only a limited number of declinations. Reason D is not correct. Non-admitted insurers do not hold certificates of authority in Arizona. They must be eligible unauthorized insurers instead. Question 17. In the context of insurance contract formation, which of the following best exemplifies the offer element? A. A policyholder's notification to the insurer of their intent to renew coverage. B. An insured submitting a claim form to the insurer after a covered loss. C. The insurer providing the insured with a temporary binder pending final approval. D. The applicant's delivery of a signed insurance application and initial premium to the insurer. The correct answer is D. The delivery of a signed application and initial premium by the applicant to the insurer constitutes the offer which the insurer may accept to form a binding policy. Reason A is not correct. This option describes a renewal intention rather than a concrete proposal indicating willingness to be bound by specified terms. Reason B is not correct. Submitting a claim occurs after contract formation and relates to claims handling, not to creating an offer. Reason C is not correct. Issuing a binder is an interim form of acceptance or temporary coverage, not the initial proposal or offer. Question 18. Within an insurance contract, what constitutes the insurer's consideration? A. The insurer's promise to provide indemnity for covered losses. B. Payment of premium by the insured in exchange for coverage. C. Disclosure of material facts by the insured during application. D. The insurer's retention of underwriting profit. The correct answer is A. In insurance contracts, consideration consists of what each party exchanges. The insurer's promise to indemnify covered losses, while the insured provides premiums. Reason B is not correct. This reflects the insured's consideration, not the insurer's promise. Reason C is not correct. Disclosure of facts is a duty or warranty, not consideration exchanged. Reason D is not correct. Underwriting profit retention is a business outcome, not contractual consideration. Question 19. Which statement best describes the competency requirement for parties entering an insurance contract? A. Parties must possess legal age and mental competence when the contract is formed. B. Parties must each have a direct financial interest in the insured property. C. Parties must apply for coverage within 30 days of the loss occurrence. D. Parties must adhere to the insurer's underwriting guidelines for eligibility. The correct answer is A. Competent parties in an insurance contract must have legal capacity, meaning they meet the requisite age and mental soundness at the time of contract formation to ensure enforceability. Reason B is not correct. Having a financial interest relates to insurable interest, not to legal competence. Reason C is not correct. Application timing after loss pertains to claims procedures, not competency. Reason D is not correct. Underwriting guidelines concern eligibility, not the legal capacity of the parties. Question 20. A business owner purchases commercial property insurance to protect against fire damage on a warehouse. The insurer is unaware that one section of the warehouse is used to manufacture counterfeit electronics, a federal crime. After a fire destroys that illicit section, the owner files a claim. Considering the legal purpose requirement in insurance agreements, what applies to this policy? A. The insurer must honor the claim because it did not know about the illegal activity. B. The contract is valid for the lawful portion of the warehouse, but void for the illicit area. C. The contract is void in its entirety, so no coverage applies to any loss. D. The policy is voidable at the insurer's option, but enforceable at the insured's choice. The correct answer is C. The legal purpose requirement mandates that an insurance contract must have a lawful object. When any material purpose of the contract is illegal, the entire agreement is void ab initio and cannot be enforced. Reason A is not correct. Ignorance of the insurer does not validate a contract with an unlawful purpose. Reason B is not correct. An illegal purpose cannot be severed from the contract. The whole agreement is unenforceable. Reason D is not correct. The insurer cannot merely void or enforce one-sidedly. The contract is void itself. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.